Great. Well, welcome everybody. We see the numbers climbing, so we're going to give us a minute to get everybody situated, and then we will get started. For those of you just joining us, welcome. I'm J.Thelander. We're going to give us another couple of minutes and like another minute or two because the numbers are climbing for those of you joining us. But we know you're here and we're looking forward to getting started shortly. Okay, great. Why don't we get started? I'm J.Thelander. I'm going to turn it over to my colleague, Max from PitchBook. And Max, we'll let you take it from there.
Love it. Thank you so much, Jody. We're going to kick off today's webinar. This is our Insights into Investment Firm Compensation with J.Thelander Consulting. My name is Max Navas. I'm a venture capital research analyst here at PitchBook, and I'm joined today by J.Thelander, founder and CEO of J.Thelander Consulting, Jim Jensen, partner at Wilson Sonsini, Goodrich & Rosati, and Melissa Telton, partner of New Enterprise Associates. As we start off, I just want to mention today that today's webinar will be recorded, and a link to the webinar will be sent out to all registrants via email within the next day or two. Please remember, if you have any questions, to add them to the Q&A feature in the Zoom field, and throughout today's webinar, we will answer as many questions as we can following our presentation. Thank you. So today, if you're not familiar with PitchBook, we're the leading resource for comprehensive data, research, and insights spanning the global capital markets, including PE, VC, M&A, and emerging technology spaces. You can learn more about our platform and new features at pitchbook.com. Before I hop into today's presentation, I just want to highlight a few relevant reports from our VC team here at PitchBook. Our most recent Q2 Venture Monitor report, a lot of that data will be covered in today's presentation. We have our US VC valuations report, and then two recent analyst notes on accounting for the overcapitalization in VC, as well as challenges for emerging managers. When we kick it off today, would love to just give a few takeaways that we're seeing in the broader VC market. First of which is the US VC market is the most investor friendly we've seen in a decade in terms of deal sizes, deal terms, and a lot of the negotiation that's happening. The IPO window remains shuttered, and this is dragging down exit value and limiting paths to liquidity for a lot of investors. And these two factors in tandem with several others are creating a lackluster fundraising environment through the first half of this year, as funds feel the brunt of a lot of valuation run-ups in the past couple years. To begin, I'd love to hop into US VC deal activity. In the first half of the year, we saw $85.6 billion invested in an estimated 8,200 deals. The first half deal count in the first half this year has fallen 17% from the first half in 2022. And Q2 of this year's deal value of $39.8 billion has set a 12-quarter low, highlighting just how far the slowdown has come. When we look into the effect of this slowdown and the compression, as I mentioned in the market, we saw median deal sizes and pre-money valuations fall across most stages, venture growth all the way down to early stage. We saw the venture growth median deal size fall from 19.3 million in 2022 to just 10.3 million through the first half of 2023. And when we look over at pre-money valuations, venture growth saw an even more drastic decline from 336 million in 2022 to 126.3 million in 2023. The silver lining, or the exception to this compression, has been the seed stage thus far. They've been fairly insulated from the public market pressures and compression we've seen for deal metrics, but they're not immune to that. We may see some of that compression happen in later stage in the seed stage as we progress into next year and further. One of the things our team puts together a model is the VC dollar demand to supply by stage. And this looks at the amount of capital available to each stage, as well as the demand. And in particular, when we look at the late stage, there's nearly $3 demanded for every $1 supplied, highlighting the capital crunch due in part to the pullback from later stage investors as the market has yet to find its new equilibrium, a retreat of non-traditional investors that wanted to access this asset class for its returns, but in recent years have seen those returns kind of fall off. And so we don't have the same amount of investors pouring capital and deploying capital into deals that we once had. Finally, we have our VC deal making indicator that looks at the friendliness of the deal making environment, either towards founders or investors. And what we see is the pendulum started to switch in early 2022. And now, as we have come to the first half of 2023, the environment is the most investor friendly environment we've seen in nearly a decade. And this means that deal sizes, valuations, deal terms are there's a little more leverage at the bargaining table for investors to bring those down to earth or to fit the profile and targets that they're seeking. Transitioning into the US VC backed exit activity, in the first half of 2023, we saw $12 billion in exit value generated across 588 exit events. In Q2, we had our lowest quarter in more than a decade at $5.5 billion in exit value. And a lot of this has to do with the pressures that we're seeing in the public markets. One of the models that I haven't shown here today, but we do track, is a model that estimates the number of companies sitting or waiting to IPO. And we estimate that there's more than 200 private companies in the VC market that are looking for liquidity once conditions improve. Much of the efforts to go public also have to do with the ability to maintain share value, especially for investors that are locked up after that event. When we look at our index for US VC-backed IPOs, we've seen since the start of 2022 that the value has declined by roughly 50%, just showing how difficult it is for some of these companies to perform or achieve performance metrics at the standard that investors are looking for. Now, there's been a few recent IPOs that are definitely testing the waters and potentially inspiring confidence for investors and founders alike. The first of which has been Kaba's IPO earlier this year, and they've maintained their share value fairly well. But even more pertinent, I guess, to the reemergence of the IPO market could be the S1 filings from Instacart and Klaviyo that we saw earlier this year. Both could be helping pioneer this reemergence. But in particular, we look at those two companies, they both achieved profitability prior to their filing, which is something a lot of other tech companies may not be able to do so, as they may be unprofitable or having high burn rates that may not be as attractive to investors in the public markets. Finally, we pop into US VC fundraising activity. Through the first half of the year, we saw $33.3 billion committed to 233 funds. We're on pace to set a 6-year low, with the full year value coming in lower, just below 70 billion is our estimation. And a lot of this has to do with the changing landscape of deal making, liquidity available to investors, and what we've seen in the interim period in terms of fund performance. To begin with, we've seen that established managers, those with longstanding LP relationships and successful investment track records, have fared better than their emerging manager counterparts, and through the first half of the year captured just over 80% of all the capital raised. So a pretty stark skew of capital in their favor. Additionally, there's just LP hesitancy in the market. This is, coupled with the falling deal metrics, maybe markdowns they're seeing in their portfolios. And it's also meant that managers that are out there fundraising are not raising as large of funds. One stat in particular, we saw that just in the first half of this year, only $7 billion or larger funds have been closed, as compared to 33 we saw in 2022 and 2021 we saw in 23 we saw in 2021. And that could be because a lot of these managers that were able to raise these large funds have done so in prior years, but also the need to have that much capital to deploy is not as great as it was in a market with frothy valuations and investors competing some of those metrics to higher levels. Again, I mentioned that the interim performance of funds is definitely something that's giving LPs a little hesitance to further deploy capital in the market. And when we look at our rolling 1-year horizon IRR for VC funds, we see that it's become incredibly difficult. Just halfway through the 2022, we saw those IRRs go negative. And for funds that have more than $250 million in commitments, which largely invest in later stage or venture growth stage deals, fell the brunt of those valuation run-ups and are now paying for it in terms of their interim performance. The Q4 2022 IRR for funds with $250 million or greater was negative 17.2%. And before I pass it back to Jody, I just want to hop into our private equity market. So when we look at PE deal activity, we saw another mixed quarter in Q2. Q2, we saw $191.2 billion in deal value, down about 49% from its peak in Q4 of 2021. But on a positive note, our deal count remains ahead of pre-COVID levels by over 50%, but we've just seen a stark drop in that value that's been invested. Moving into PE exit activity, we continue to see this large drop-off in the exit market. Both exit value and count remain below pre-COVID averages. And the investment to exit ratio continues to pile up. We're seeing about 3 investments for every 1 exit in the market year to date. And a concern for a lot of PE investors is this fast approaching maturity wall. PE funds nearing their term life to distribute capital back to investors will have to wrestle with the idea of finding liquidity from investments amid a little more harsher public market conditions and exit environment. Finally, PE fundraising activity continues to be a challenge. Through the first half of this year, $153 billion was raised across 160 funds, tracking about 15 to 25% below the pace of the first half of the year of 2022. But the surprise that a lot of our PE analysts called out in their US PE breakdown report has been the turnaround in middle market funds. So these are funds sized $100 million to $5 billion, have accounted for 57.4% of fund value and over 60% of all fund closings year to date. So with that, this is just a little snapshot of the private markets. We'll pass this over to Jody to continue. And again, if you have any questions today, feel free to add them to the chat bar and we'll do our best to address them as they come up.
Great. Thank you, Max. I'm going to share my screen now. Okay. Perfect. Well, that was a lot of great information. I think the reason that we're here is to discuss how does that impact compensation. So I'm going to jump right into the deck, and please feel free to send your questions. We'd like this to be collaborative. We have a lot of information here, and we can jump around based on your questions. So, and we have someone monitoring the chat. Okay, so we've been partnered with PitchBook now for almost 10 years. We're 9+ years in, and you can activate your free investment firm and private company subscription from our online platform as a PitchBook client. Just email Morgan at J.Thelander, and we can get you access to the platform, which will have a subset of information from the full data set. And we have a table of contents here, just so you know, in case you have questions, all the way from the background on the data. We are going to talk about cash and carried interest, about carried interest, specifically carry dollars at work, the investment firm structure and succession planning. We have current survey information and data on diversity, equity, and inclusion. We've added new questions on advisory board compensation, which actually I think has come up from some of these webinars, salary increases, bonuses. So more to cover here than we will have time for. But again, if there's something that is of interest to you, please let us know. So by way of background, we've been running these surveys. We've been in business here. I'm the founder and CEO for 25 years. And the biggest update that we've had is that the data and the surveys are now real time. And so we run several surveys, one on investment firm compensation, another on investment firm salary increases and bonuses. And then we also cover all the compensation and data for the private company. So really the full holistic ecosystem of the private markets. And by way of background, and we take a snapshot of this on a regular basis. So this just gives you a sense that 44% or so, almost half the data is venture, and then it's moved around between PE and the different other types of investment firms. The way that we really like to look at information is by the value of total of assets under management. And we find that, and now we've added, we used to just be the 1 billion plus and then 2 billion plus, and now we have a very robust group of investment firms that are at 7 billion plus. And Melissa, maybe you'd like to share with us. I know that NEA is a very large fund, and you have a lot of other sort of people that you invest with a large asset under management. Tell us a little bit about what that's like.
What having large AUM is like?
Yeah, exactly. Like the growth, how you've grown from you keeping multiple funds, because years ago, a firm like yours was not at a large asset class. And now it's changed the infrastructure.
Yeah, so I think a firm evolves. Certainly NEA has, I think a hallmark of NEA has been the ability to evolve. We're about a 44-year-old firm, so we've been in the game a very long time. And literally, I think one of our hallmarks is just being really open-minded to what has to happen, both from a macro modification and also within internally in NEA. So I think, talent is where I focus, and we're always looking at the evolution of venture talent as well. And as you grow and scale, you really need different skill sets. We're multi-stage, so everything from seed until late stage. And so it requires a lot of different mindsets and a lot of different talent at the table.
Right, because it sort of goes to the next slide here about how many funds are currently being managed, and that 6+ is where the larger assets under management, and it really also goes to, this is by total AUM, right? So you can see that the larger billion plus AUM has more of the 6+ funds that are being managed. And that also talks about the global footprint. I know, Melissa, you just mentioned that you've been traveling a lot globally. Jim, I know you've been traveling too. The funds now, there may be a primary location of your firm, but there are also locations, 82% or almost 83% within the United States. But there is a whole global footprint in terms of investment and where there are multiple offices.
Yeah, we've seen a lot more traction in Europe, which is very exciting. So London Tech Week, for example, was the busiest it's been in my attendance. So really exciting growth.
Yeah. And we do have some great data on Europe versus the US for exactly that reason, that finally now there is enough of a sample size to be able to show that data. And then within the United States, you can see that there are offices, locations with all that, it's not just a Bay Area thing anymore. Obviously, New York and the other parts of Northeast, very prominent, and the Midwest. Okay, and location within Europe, Western Europe. This is just by way of background. Okay, this is the part that's really grown so much with the list of investment firm positions. And I think this is part and parcel of what we've seen with the asset classes growing, the total assets under management, is there is no longer just the investment team. There are all kinds of other administrative and supporting roles for the portfolio companies and for the actual investment firm themselves, which includes business development, talent, human resources, marketing, director of people, platform, all the accounting functions. There's been just tremendous growth in many of these roles at all levels, not only VP, director, manager, and that really is significant in terms of what J.Thelander does with our comp data, because we cover all of these positions with a mix of cash and carry. And then the other side of the house, there's a separate survey that covers corporate venture. And we're not going to stand down on that today and not get into it, because it's a whole separate lane in terms of how compensation is structured. We also now publish the J.Thelander Digest. These are all the different topics that we've covered. So if there's anything of interest to you, certainly glad to send that out. There was a question about whether the deck today was going to be made available. Our deck will not be made available, but if you'd like to schedule a time to discuss something specific, we're certainly glad to do that. And if you do happen to take a picture of anything today, we would appreciate not putting that up on any online or in any public place, because everything is copyrighted. Okay, let's get into some data. The different levers for compensation, and Jim, I certainly would love for you to jump in here too. On cash compensation, typically inside of an investment firm, is base salary, a current bonus, which is the bonus that was actually given, a target bonus, which is the bonus out on the horizon. This is for the next year, which you can arrive at total cash either from a combination of just your base pay or a combination of base and bonus. And then the other incentive compensation, carried interest, carry dollars at work, and sometimes we also see an equity distribution. Okay, here's a little comp data, and Melissa and Jim, I certainly would love your thoughts on this as well. From you both have different angles. Jim is a partner at Wilson Sonsini and works quite a bit on fund formation and advising, doing employment agreements and all aspects really for investment professionals and their teams, as well as the firms themselves. And Melissa, you heading talent as well as many other buckets at NEA, you see what's happening in terms of compensation. So this is the managing general partner, and this is a year-over-year snapshot from 2015 all the way to 2023. And looking at the less than $1 billion versus over $1 billion. And the less than $1 billion is quite a big bucket. Maybe, Jim, you could speak to a little bit about what you see with the emerging funds. And we saw from Max's slides that that's become a little trickier, right? Some of that is harder money to raise right now. But Jim, I think Jim's there. Oh, there we go. Great. So talk to us a little bit about the emerging funds, fund formation, and how when you're doing an employment agreement on compensation, what goes into that?
Well, the emerging funds, the challenge relative to the NEAs of the world, and Andreessen Horowitz, is that, the cash compensation has to be lower because the management fees are lower. And so by nature, it's lower. But often, like on a carry percentage, the carry percentage is higher because the team is smaller. And so you have more upside. Yeah, you have more upside in the carry than you do in the cash compensation. But a lot of times the determination is a combination of two things. One, you look at the gross management fee and how big the team is, and you kind of figure it out that way. I mean, you can't spend more than the management fees that are bringing in. So, but regardless of what the industry or the data may show, you can't go above the management fee. So I think that's one lever. And the other one is to look at the industry statistics like this, Jody, where you look at it and say, look, within these smaller funds, this is the average cash, this is the average like bonus, et cetera. The other thing I just like throw in there is that, the salaries for startups have gone up too, just like they have in the investment professionals. But I think what a lot of outsiders don't realize is that because GPs and investment team members have capital contribution obligations, the salaries have to be higher for them to be able to pay that. So sometimes you see the salary, you say, wow, that's relatively high. Well, maybe half of it is going to capital contribution obligations. So, 10 years down the road, 15 years down the road, it may be a good investment, but at least on a cash basis now, it really cuts into the amount that people take home.
Yeah, so I think I want to recap a little bit of what Jim said, and you're exactly right. So you can see that for the less than $1 billion of assets under management, for some of these top roles, that the total cash compensation, and this is total cash. So again, this can be a combination of base and bonus or just base pay. And this is the median, that there is higher, this is the correlating carried interest, and the carried interest percentages are higher. And that's because, there's more risk at the emerging funds. So you have a bigger piece of the pie versus the larger asset class, the $1 billion plus, that you tend to have higher total cash compensation, but the carried interest percentage is lower. I'm going to move into the next slide. Here's just a snapshot of it for a senior associate. We've got a lot of different job samples here, and we wanted to give you just a benchmark of this. I know it's we have all levels of folks on the phone is dialed in as well. So this is a senior associate, and you can see how constant this is, right? Less than $1 billion, and at the $1 billion plus, the compensation relatively constant as well. There was a peak, of $300,000. But generally around that 250 mark. And then here is the carried interest percentage. So Melissa, maybe you could speak a little bit to what it's like for the recruiting level, these positions, the senior associate, that's a very competitive role. And as you can see, also a little bit tipped up if you're at a larger asset under class, but these jobs are competitive.
They're extremely competitive, and they're evolving because of the evolution of the market into AI. So now you're seeing a lot more of a mix of backgrounds of senior associates. Used to be very focused on banking recruits, and now pivoting to more technical senior associates and associates. And yes, very competitive to get a spot at a VC even now, and especially now with the market. So this all correlates well.
Yeah. Okay, I'm going to move into here's the senior. So we saw this. Okay, here's the Europe data. So this is very timely, especially what you were saying, Melissa, and we've been getting more and more questions on this. So this is the managing general partner. And I showed here the max numbers as well. I thought it was important because you can see there is a very big jump between the 25th, 50th, 75th percentile, and then the max. But the maximum numbers are very real numbers. They're not outliers because it shows, multiple data points hovering. And obviously the jump in Europe between the 75th and max is lower than the jump between in the United States. But this is looking at the less than $500 million of assets under management. So quite a big variation on the theme. But in Europe, it generally is a little bit lower in terms of cash compensation. And I don't know, Melissa, I know you're seeing and talking with colleagues there. What's your take on this?
Well, I think there's a lot of similarities between early stage startups and late stage companies comp, and then small AUM VCs and large AUM VCs. And I would say from a market perspective, the European market definitely is more depressed on comp overall, so across venture and across tech companies. And I think they are kind of adjusting to some of the US expectations. Certainly when we have our companies come from Europe and they're expanding into the US, they always have sticker shock about what talent costs in the United States. So I think this is really indicative of that imbalance. But I do see Europe getting a lot more traction and getting, moving towards the US numbers slowly but surely.
We have 2 clients right now on the consulting side where we are looking at offices in Germany and in London, and then the United States. They have multiple offices, and how to make sure that there is a holistic pay structure that can be, maybe using percentiles within a job. But there is definitely going to be, despite the fact that the European numbers might be lower now, it's unlikely as more offices, are opening up there for venture firms or private equity firms, that is going to stay for very long. So understanding the market from the global perspective is very important. Jim, we had a question and I think you're the best one to answer this. And what is meant by carried interest percentage? Is this the percentage of the firm's carried interest that the associate or that the job that we're showing gets? So, I'm going to stop sharing for a second, but I'm going to, so I can get to the slide, but why don't you give us that definition?
I'm sorry, Jody, you broke up. The carry dollars at work definition?
No, the carried interest. I'll go ahead and share my screen again. So this will give you a little bit of a talking point. The carried interest for the firm. So when we show the percentage for a job, like the associate, how does that factor into this 80-20 split? So it's the percentage of that 20%, but I'll let you have the legalese, which is a little more sophisticated.
Yeah, and I turned my camera off because I'm having some bandwidth issues. So what you think about carried interest, the legal definition of carried interest is it's a disproportionate share of profits from the fund that the general partner receives that's disproportionate to the capital commitment of the GP. So if the GP has a capital commitment of 1% of total, then the carried interest may be 20-25%. And it's just that disproportionate share. So that's how I would view carried interest. We can separately talk later about what carried interest dollars at work are, because that's become a common way to issue carry to members of the team.
So this shows the total amount of carried interest for the firm is typically 20%, meaning there's an 80-20 split. And the vesting time for carry, meaning, Jim, I'm going to recap what you said, but when we're showing the percentage for an individual role, it's of the percentage that the firm has of that. So that's typically 20%.
Yeah, sorry, I didn't know you want to talk on an individual level. Yeah, so there's carry that the general partner entity receives. And then there's carry percentage that an individual receives. And if you think about the carry that an individual would receive, is very often it's done on a 100-point scale. So you think of, okay, 20 points of carry are going to the GP entity, and then how do you divide that up? Somebody may get 45% of it, and then that's 45 on a 100-point scale.
Right. Okay, I hope that answered the question, but we'll keep going here, talking about, and I can go back to comp slides afterwards. But this is the total amount of carried interest for the firm. And then I know, Melissa, we've showed this now. We show the vesting time for carried interest, and it's come up that the vesting time, especially by the larger assets under management, has now continued to increase. So what's your experience or understanding what's going on in the market with this?
I think it's such a mixed bag. Yes, it has increased, but if you look at some, you've got 4 and 5 looking really strong there. So I think it's very dependent on the size of the fund, the sector of the fund. I think if you look at, Web3 investors, AI investors, I think there's a lot of creativity occurring right now with vesting schedules. Some of them front load, some of them backload.
Yeah, here's the question: is the vesting time equal each year, or does it change over time? So this, maybe you can,
Every firm does it differently, and it seems to be constantly evolving. I even know a firm, not NEA, that mid-fund, they allocate 50% of the carry, and then mid-fund, bringing in the best investments, they reallocate the carry mid-fund. So it really is a completely mixed bag. I would say, it evolves, and there's always pushback on both sides, but it's a moving target.
Yeah, and you can see that from the data, right? And that's why we've even divided it now. We've asked in such a granular way because we're trying to get to see if there's any consistency in the market. And the only thing that's consistent is the inconsistency, and that there's no two firms that are alike. But you can see that the questions do come up. And I think more so this gives you just a broad sweeping landscape of the different kinds of things that you want to consider as you're either starting a fund or as these questions come up. So here is what percent of the committed capital do the GPs have to contribute? And maybe, Jim, you could explain what this means, because you talked a little bit when there are higher cash salaries, and that is because some of the GPs contribute capital for their percentage of carried interest.
Yeah, and so there was an old tax rule that provided that to get partner tax treatment, the general partner had to have the lesser of $500,000 or 1% of the aggregate capital commitment. And so that's where the GP commitment, I think, started to go into fund agreements. Now it's still there, even though that tax rule is not followed in all, by all practitioners. But it's more seen as skin in the game now. So I would say the most typical number is 1% of the total of all partner commitments. So you include limited partner GP, it's 1% of that. But when you see a larger number, like 20 to 40, 24.9%, that's a very unusual circumstance. And I would expect something like that is because the founder of the fund is very wealthy and sees great investment opportunities and wants to put a lot of their money at work. But, or just, single LP that wants a lot of skin in the game from the founder, and that's another option. The other thing with these numbers to factor in is that it's become very prevalent again for the GP to make part of its capital commitment as cashless contributions. And so you do see the GP commitment going up because now part of that is done with cashless contributions, which is effectively just reducing the management fee and using the management fee to in effect pay capital contributions. It's more complicated than that, but I think you do see a trend of the commitments going slightly up because of the cashless contributions.
Yeah, Melissa, you're shaking your head. Fill us in from your vantage point. Does this come up in conversations with your colleagues, or in terms of, I know when we have individuals come to us and say they're making a negotiation for a package, or we have a fund coming to us saying that they have raised more capital. What should the capital contribution be? Tell us what your experience is.
Yeah, I think it's just very important to be fair, be aware of what this actually means and be transparent. As Jim said, you could get this, what looks to be an incredibly generous cash comp, and then if the number of capital calls you've got to step up for really be quite cash poor. And so it's a very essential conversation for any candidate to have with a VC firm, understanding what percentages they are, how do they get called, how often, how should they budget for them. Some firms have done away with capital contributions, as Jim said too. So it really is a firm dependent decision and strategy to attract talent. But I think a lot of VC candidates get surprised by capital contribution, and especially if funds start stacking. If you're maybe in 3 or 4 funds, you're getting calls for all of those funds, so it can be a massive cash drain. So just be really explicit for yourself, and as a firm, I think it's your it's part of being a high integrity employer to really make people understand what they're getting into.
Well, I think that, in and of itself is very current conversation, because the pay transparency is in many states. And while it is not necessarily applicable to the venture industry, it is very much on people's minds to want to understand what the whole package is. And I think that's where, our compensation levels have having structure around job descriptions and all this information. It's not the single answer, but it is, at least there is structure to be able to make your decisions on, and having the data that it addresses the multiple levers of compensation. It's very complicated, right? At the venture, looking at here's the percentage of capital for an investment professional to contribute for the most recent fund for their carry. And I think that distinction you made, Melissa, that it could be stacking multiple funds, right? So you may contribute for one fund, and maybe then another fund is being raised and you're going to contribute for that. It's not like it's one and done. And you can see that these percentages and the sample sizes get smaller, because not every level will contribute capital for their carried interest. So obviously very common at the top level, and less so maybe at the senior associate. We don't even have the associate level here.
And I think that answers a question I see here. How do firms balance the requirement of committed capital with DE and diversity and inclusivity goals? Many folks are cash poor going into these leadership roles. So you'll see that correlates directly with this data. Firstly, absolute transparency with those candidates should be with every employee. It should be the same, absolute transparency. And then often, the younger, earlier stage in their career, employees will get a lot less committed.
Yeah, and we'll look, we can glance over the DE&I section, but that's a great question. And because the practicality of this, listen, the data is great and we have a ton of it, and we can help, look at all the different job titles and the compensation and the cash and the carry. But the reality is, how is it put into effect? And there are, obviously, it's challenging because, Jim, you said it, right? If you have someone who's been really successful and has already had not everyone is getting a carried interest return, and the vesting time shows you that it can take a very long time until you've had wealth creation. And the emerging funds and the funds that have lesser assets under management, using to structure their compensation, you can't assume that everyone has the ability to contribute capital right out of the starting gate. Jim, I know you had mentioned the carry dollars at work, but it's a more prevalent way. So it would be great if you could talk us through this.
Yeah, let me just throw in one thing on the capital contribution too, is that the most common way to allocate capital contribution obligations among the team is based upon your carried interest percentage. And so be careful, like everybody wants a greater carried interest percentage. And like you're at a big fund, like you get 8%, you're senior. Like if you get 8% of a fund at one of the big funds, but that can be a big check, related to that 8%. And so it comes with strings. Now, the one thing is more likely the more senior people can use cashless contributions too. So there is a benefit to those individuals where they can use part of the management fee to pay their capital contributions. Let me jump over to carry dollars at work. And so I would say, but
Jim, before there was a question that says that, does it increase in scale with assets under management, the committed capital? Does it increase? And it does increase in scale because, the bigger the fund, your percentage means that you contribute more.
Yeah, if the GP commitment is a percentage, which it often is, it just scales. So if you have, funds like Melissa's now that are raising, $8 billion in a year or whatever the number is, those are big GP commitments because they're based upon a percentage. And, and some GPs try to cap them at a dollar amount, and sometimes that's successful, but more often than not, it's a percentage. And so it just continues to scale. And then Melissa said, you're across all of these funds, where you tend to get your like carry dollars maybe at years 8 or 9 or after. And so for a long time, you're writing checks without getting anything back.
Yeah. Yeah. Excuse me. All right, Jim, I interrupted you, but we had the question come in. We want everyone to know we're paying attention to your questions, and we certainly want to address them. But tell us about carry dollars at work, because that's a section that we've added over the past 10 years, and it's become more prevalent as a way of looking at the carried versus just a straight percentage.
Yeah, I'll jump in. One final point, but I would trade places with Melissa in a heartbeat if she wants to do it. So no, it's still a great job to have if you can get it. So the carry dollars at work is you look at you know, and let me just give you an example. I think the easiest way to think of it is that you have a fund that's 100 million in size. You think of the fund doubling in size, like you return capital and you get a 1x, which unfortunately in the industry is not that unusual, you know, for a fund. And then you think about what percentage of that 100 million of profit is carry, say 20%, so $20 million. So the maximum carry dollars at work of that fund is $20 million. And then you go to an individual, you say, look, you have $500,000 carried interest dollars at work. So if the fund doubles, they make 500,000. If the fund triples, they make $1 million. But it's a really easy way for an individual to try to, you know, look at it and say, okay, this is what I think I can expect to make. The other thing I think is that if, you know, the percentages for a lot of the team members are so small, particularly at the big firms, you don't necessarily want to highlight that, oh, you're a 0.1 percenter. So you give it in carried interest dollars at work instead, which makes them feel better about their, you know, their interest.
Yeah, here's some numbers here. So I'm going to switch to, I know, okay, I like this slide on managing director / partner, because it's a very common job, right? So this shows you, maybe you could talk through this, Jim. This is the assets under management, right? So we're showing the different sizes, less than 500 million, 500 million to basically $1 billion and $1 billion plus. The 50th and 75th percentile about how many carried interest dollars do you have at work across all active funds?
Yeah, so it's interesting. So if I'm reading this right, it says for $1 billion fund, there's 10 and $20 million of carried interest dollars at work across the $1 billion.
Yes, that's the 75th percentile.
Oh, for a managing director, I'm sorry. It's not for the aggregate. Yeah, so it just means that of, you know, so say the real carried interest dollars at work across $1 billion is $200 million. That managing director or partner is getting 0.5% of this, and that's translating in this, you know, this $10 million. You know, that number is relatively low, but that's because it is a large fund with a lot of managing directors there. I think in one of your prior slides, you said, like, look, like a managing partner, maybe 40%. Well, that's true if it's a smaller fund.
Yeah. Here's the numbers for the managing general partner. So you can obviously see that these are projections, right? So these are not actual. I mean, you can't, this is what you're hoping for with the 2x multiple.
Yeah, but just a 2x fund, which is not a great fund, 62,500,000. Good job to have.
Yeah, it's a great job to have. We've had a lot of questions, Melissa. I'm going to let you ask these questions, reiterate them. I'm going to close the deck for a second and move back to the carried interest numbers and look at some specific data, because we've had a lot of questions come in the chat.
Yeah, so some of these I really can't speak to kind of accurately, but one question was, what are the strings attached to cashless commit programs? And one thing I would just say in terms of carried interest, and Jim, I'd love to hear what you're seeing in the market. A lot of firms used to have clawback if you went to a competitor, for example, so they would claw back 50% of your carry. Something really important for you to know before you join a venture fund, what their clawback terms are. So Jim, do you want to speak to that? Because I think that's a really useful thing to understand.
Yeah, do you have to be present to win, or can you take the carry with you if you have invested for your carry? What happens? I know we ask all these questions in the survey, but from your angle.
Yeah, and I'll keep it brief. I think a part I really don't like about the venture fund model versus startups is that if you do leave a venture fund, very often it's not a non-compete, but it's a reduction in your carry vested percentage. So you keep your vested percentage. You often sometimes continue to have to make capital contribution obligations. But if you go to a competitor, you solicit LPs or otherwise, you lose part of it. And if it's like a cause termination, you lose 100% very often. And maybe that's not bad because it's cause. But the competitor one always strikes me as not the, fair, but it's very prevalent in the industry.
Yeah, I personally have seen it kind of change over time. I think it was completely black and white. Everyone did it. And I think a lot of firms have realized that in a way it's imposing a non-compete. So they're doing away with it. But something to be very aware of when you negotiate your employment contract with a firm, that if you do leave, some of them will claw back a significant percentage of your carry.
The other question that came up, and I know, Jim, because you've actually said this over the years, and our data does show this to some degree, that the percentage of carried interest you get correlates to the percentage of capital that you have to contribute. And you said it, but maybe you could say it again and just say it slowly. That was the traditional model, but it doesn't always stand true today.
Yeah, so if you have a 20% capital commitment, that you have 20% of the GP's commitment, you have 20% of the carry dollars. And at the senior level, that tends to be a ratio that's followed fairly closely. Sometimes at the senior level, though, actually, they have a greater percentage because some of the more junior people don't have to have capital contribution.
Yeah. The other question that came up, and we've certainly seen this in consulting, is there any case a firm decides to reserve some of the percentage of carried interest because they may, in some cases, be for the purpose of that would be because they're going to hire more people. I don't know, Melissa, have you seen this from your experience?
Sorry, I was reading questions. Repeat the question.
Do you reserve some of the capital of the carried interest, or is it all allocated?
You know what? I am not sure about that. Jim, what have you seen in that?
Yeah, it's we do it with a concept called a suspense account, where a certain percentage of it is held back. The challenge with it is it's hard to dole it out after it's ripened into value.
Correct.
And so, but what fund managers are surprised about is most funds actually don't do the GP agreement and the allocations up front. They figure out who's helped in the fundraising, like a little, who's going to take an active role in the fund, and then they kind of dole it out at that time, and then a portion of it reserved.
Right.
But
yeah,
like,
you may have an extraordinary outcome with a specific investment, right? So I could see where if they had reserves of carry, where a certain partner who had maybe brought and I'm not speaking on behalf of any, I'm just saying generally speaking,
right.
If a certain partner had brought, a complete outlier and fund making company, then upon exit and distribution, they may get allocated some of that additional carry.
And also, we see in the consulting side all the time that if you raise a fund and it's very successful, that you then want to change the carried interest percentages for the next fund because you hadn't predicted that, you didn't know that you were either going to be wildly successful or things weren't going to be quite as successful. So you have to adjust. And also, you are maybe hiring more partners, or somebody may be leaving a firm. I mean, there's been obviously a lot of shakeup in both venture as well as private equity. And just because someone doesn't stay doesn't mean you're not going to hire somebody else. Something might not have been successful with that mix of person. So there's a lot of cases where that does happen. And also a question came up, and I'm going to share this slide as well, just to keep us fresh with some data. Is that there are cases where you don't have to contribute capital for your carry. And that can be in the beginning of a new fund, an emerging fund, or it can be, just each firm is different. There's not always a guarantee that you have to contribute capital for your carried interest. I see, Jim, you're shaking your head yes on that.
Yeah, I also think the bigger funds, you have both cashless, and then you also have where the bigger funds go to a bank and arrange, like loans, so people can borrow against and then kind of pay it off over time with low interest rates. These funds are so profitable that generally you can get a really good rate from, like the bank I knew that did it, First Republic, which, I don't know if they do it anymore or whoever took them over, but
Well,
those are out
Silicon
there.
Valley Bank used to do a lot of that too. A
Right,
lot.
exactly.
Yeah.
Exactly. Okay, so here I wanted you to see, because also a question came up, I'm just trying to keep up with what everybody's interested in seeing, is the other titles, and other than this, the top people or the managing. So here's some other roles showing you. And Max, I love the fact that you showed a couple slides and they look just like ours, look like yours. So it means we're doing a good job because we're following the PitchBook rule. So here is the total cash is what's on the bottom, and then the percentage of carry, right? And you can see though that, and again, this is the 75th percentile, because I think it's healthy to look at different, not always the median or the average. So that things are relatively constant though. So the 2021, 22, 23, the percentage of carried interest, and then the managing director / partner. And those percentages of carried interest, because some of those more mid-level jobs in which we consider a managing director / partner, those jobs are very competitive. And that's sort of the inflection point where you really start to get from your carried interest percentage into a more senior role, and you really get in the game higher. But you can see the cash has stayed constant, but a little bit of uptick in the carried interest percentage. And then here's another job for associate. But yours is total cash, very constant, less than $1 billion, and relatively constant for $1 billion plus in terms of the total cash. And then here's the percentage of carried interest, really for the larger funds has dropped, and for the less than $1 billion of assets under management has stayed relatively constant. So I think this just gives you breadth and depth of a little bit of the information that we have. I'll show you a couple other slides, senior associate, and this, because we had several questions on this as well. Talking about the base salary, current bonus, and total cash. And again, you can see that the base plus the bonus does not equal total cash because the sample sizes are different. But in general, you're looking and you can see the carried interest percentages staying relatively constant. Yeah.
We've been asked to look at management fees, if we have data on that.
Investment, let's see. Got for... Let's see, investment, diversity, equity, inclusion. I don't know if I have the management fee information in terms of how it's structured. Maybe Jim, you can talk to us a little bit about that. And I'm going to pull up the information just on the, the succession plan, the firm headcount, and the structure there. But we don't have the section on management fees in here.
Yeah, I think actually PitchBook probably has that data, I would think. But, many of these funds are 2.5% during the investment period and then step down after the investment period. So maybe a floor of 1.5%, typically based upon capital commitments. I still think the most common rate out there is 2% of capital commitments during investment period and then stepping down after that. But I don't have any exact data on, what percentage of funds is in each bucket.
Yeah, happy to hop in here. That's definitely a point that we look to track is the management fee and carry split. As you mentioned, Jim, 2 and 20 is definitely the most common, but we have outliers a little above and a little bit below, just depending on the size of the fund and where they are with their investment track record. But yeah, the 2 and 20 is by far the most common split we see within the data.
Yeah. And the survey part and the compensation, we don't get really into the management. That sort of falls out of, that starts where we stop in terms of compensation. I would like, since we're winding up here in terms of time, just what is out on the horizon. We showed you a current snapshot, but as we look to the end of the year, the salary increase and bonuses is sort of the next chapter of what's coming. And this was, did you receive a salary increase for the coming year? And this is showing, year over year, all positions for 2021, 22, and 23. So it looks like salary increases are on, more likely to be coming. And also, if you received a salary increase, what is that looking like? Did you receive a salary increase? And you can see at the more junior levels, it's more prevalent, because at the top levels, it's probably less of in Melissa, fill us in from your angle on this, right? It's more the competition for talent at the junior levels and mid levels, where salary increases are important because you really got to retain people.
Yeah, and I think it's relative to what people are taking home. It's the same at large companies. I think you're seeing a lot of pressure on kind of senior leadership to not have comp increases right now, given the macroeconomic environment. So it is, a lot more common to see the more junior roles get comp bumps.
It's the same thing in the portfolio companies. Max
Yeah.
was showing this in the PitchBook numbers that obviously there's still always competition for talent. And Melissa, you mentioned AI, obviously very hot markets, and life sciences has always stayed very hot. So there are those talented people, regardless of what's going on in the more global perspective, you got to keep the talent that's key. Some other roles, it depends on if there was an uptick a couple of years ago in salaries where we were using the total cash was at the 75th, and max numbers were used as more prevalently because there was such a competition for talent. So this is not a singular answer. It really depends on where that person came in, how valuable they are to the organization, and sort of what's happening at the firm today. I have one slide I actually do want to show, because I know this comes up all the time. People talk about geography as well. And, we are not seeing that there, especially within the United States, that there is, depending on where the firm is located, that the competition for, talent, regardless of where the job is, that it really depends, right? And this shows you, because it used to be that the Bay Area was so expensive, and that's where people were being paid the most. But here's an analyst pre-MBA for total cash. And you can see Northern California and the Northeast, but then the Midwest, because there's a growing number of venture firms there and investment firms, and the competition for talent, those people are fewer and far between. So there is a little uptick in the cash compensation. And Melissa, I don't know, what have you seen? Because you have offices all over, and I know that you talk to other colleagues, not necessarily NEA specific, but are you seeing a big difference for, the locations of where people are in the United States?
Yeah, we've seen a real trend for anyone with no kids or kind of under 35 wanting to work in New York City. And that's been a huge bump post-pandemic. I do see San Francisco coming back quite aggressively, especially with AI, a lot more space getting rented and younger people wanting to be part of that movement. So hard to be a part of that when you're not in Silicon Valley still. But definitely New York has got a lot more people, a lot younger talent market that's booming right now.
Yeah, that's great. Well, listen, we're winding down. It's 1:57. It's been a great audience today, and we really appreciate also the panelists and your expertise. You can see there are a lot of moving parts here. Understanding the perspective, like Max provided, of what's happening in the global perspective in the markets. And obviously we know there's been some pressure. The IPO markets are lackluster, and how firms are handling this in terms of fundraising and deploying capital, and also how that impacts the compensation and keeping your talent. And Jim, the legalese and the specifics for your firm, there's no one way, and the data shows that as well. And a big thanks to PitchBook. They've been a great partner, and we've been lucky to be working with them over all these years. Again, if you would like to have access to a subset of these results, just go ahead and email Morgan at J.Thelander.com, or talk to your PitchBook relationship person, and they will follow up with us as well. And we thank you. The recording will go out, and PitchBook also will make their slides available. So thank you to everybody, and we look forward to hearing from you in the near future.
Thanks, everyone.
Yeah, thank you.
Thank you very much.